So I'm Jennifer Smagula. I'm a healthcare actuary with Gorman Actuarial, and I'm joined here today with my colleague, Don Gorman. And I'm going to take you through the key findings from our report on the 2013 healthcare cost drivers. So just as background, again, the goal of this report is to examine premium rates and the factors contributing to those rates, and the focus this year is on 2013. So this first slide gives a picture of the membership distribution by carrier, which is shown on the left, and by market segment, which is shown on the right, for the private fully insured market in New Hampshire. And by fully insured, I mean that the employer group or the individual pays a premium to the health insurance carrier, and the health insurance carrier is responsible for the claims for those members. And this is in contrast to a self-insured arrangement, where the insurance carrier administers the plan, but it's the employer who is responsible for paying the claims. The primary focus of our report in this presentation is on the fully insured market and trends in those markets. So in 2013, there were 4 carriers that comprised approximately 96% of the fully insured market. And those carriers are Anthem, which includes the Matthew Thornton Health Plan, Harvard Pilgrim, Cigna, and MVP. So much of our data for this report comes from those 4 carriers. Now again, the right-hand side shows the distribution by market segment. So that's the individual, the small group, and the large group market. So a lot of our data and analysis looks at these 3 market segments separately, but we also look at things in total. The overall premium per member per month in the New Hampshire fully insured market increased 3% in 2013 compared to 2012. So this is up from the overall premium trend reported last year of 1.1%. The premium PMPM shown here include both the portion paid by the employer and the portion paid by the employee in the case of the group markets. And as you can see, the individual market has the lowest overall premium PMPMs, and this is primarily driven by 2 factors. One is that the cost sharing, the plan designs in the individual market, there tends to be higher cost sharing, therefore lower premiums, but also driven by the fact that health underwriting is allowed in the individual market in 2013. And just to note that as a result of the ACA, health underwriting will no longer be allowed in 2014 for ACA compliant plans. Now the other thing to note is that we refer to these trends as unadjusted premium trends in the report. And by that we mean that these are premium trends as reported by the carriers, and they have not been adjusted to reflect the fact that employers or individuals may be moving to plans with higher cost sharing and therefore lower premiums. And this is a process we call benefit buy down. So again, benefit buy down is this process of selecting a plan with reduced benefits or higher cost sharing as a way to mitigate premium increases. And benefit buy down has occurred in all market segments, but most notably in the individual and small group market. So this chart looks at the membership distribution for a key component of cost sharing, the deductible. And this information is for the individual and small group markets combined, and it shows the shift towards plans with higher deductibles. So for example, in these 2 periods that we looked at, 2011 to 2013, the percentage of members with deductibles greater than or equal to $3,000 has increased significantly from 37% in 2011 to 58% in 2013. So using information from the carriers on cost sharing changes and changes in actuarial values of plan designs, we can estimate the impact of this benefit buy down. So this chart shows the unadjusted premium trends that we looked at a couple slides ago along with the estimated impact of benefit buy-down to try to estimate what the premiums would have been in absence of any plan design changes. So for example, that second bar, the small group market, if small group employers had not changed their plan designs from 2012 to 2013, the overall average premium trends would have been in the range of 6 to 8%. So this is what we've referred to as benefit adjusted premium trend. However, since they did buy down or purchase plans with higher cost sharing during this time period, the resulting unadjusted premium trends is 3.7%. So in the overall fully insured market, the benefit adjusted premium trends is estimated to be between 5 and 7%. So this again includes both the impact of the increases to the premium, but also the increases due to the fact that folks are moving to plans with higher cost sharing. So we've been talking about premium trends, and now this slide demonstrates the three major components of premium. So overall in the New Hampshire fully insured market in 2013, 79% of premium went towards paying medical and pharmacy claims, 16% went towards paying expenses, and this includes any taxes, fees, or assessments, and the remaining 5% went towards carrier profits. So there are differences by market segments, as you can see. So in the individual market, 24% of the premium went toward expenses, including fees and assessments, and 10% went towards carrier profits. So these are, you can compare how these are higher to the group market. And there are several reasons that may contribute to some of these differences. So one is that fixed expenses as a percent of premium are going to be higher in the individual market. And secondly, that profit margin, a part of the profit margin is used to cover against adverse risk. And in these smaller blocks of business where there's more volatility and less credibility, there is part of that profit needs to go towards covering that additional risk. So the results shown here in 2013 are fairly consistent with what we've seen in the past years, although there are some differences by market segment, and there is a general increase in the percent of premium that's going towards expenses. And so we have some additional detail in some of the subsequent slides. So this next slide gives some information related to the rebates from the federal MLR program in 2013. The Affordable Care Act established minimum loss ratio standards on a nationwide basis starting in 2011. These standards create minimum requirements on the proportion of premium that must go towards paying medical and pharmacy claims and quality improvement costs. Carriers who do not meet the MLR requirements must pay refunds or rebates to their policyholders. So based on the 2013 MLR requirements, 5 carriers in New Hampshire paid rebates to their policyholders. In the individual market, $4 million, or approximately 3.1% of premium, was paid back in rebates. In the large group market, $1.5 million, or 0.2%, was paid a premium, and there were no rebates in the small group market. So in total, across the whole state, $5.5 million, or 0.4%, was paid back in rebates. So one thing to point out that in the previous slide we were looking at, these percentages of premium are presented prior to any federal MLR payments. So these profit margins shown here are ultimately reduced by the amount paid back to policyholders in rebates. So for example, in the individual market where 3% of premium was paid back in rebates, this 10% profit would ultimately be reduced by that 3 percentage points down to roughly 7%. So as we saw in the previous slide, medical and pharmacy claims are the largest component of health insurance premiums at roughly 79%. The left-hand side of this chart shows the annual allowed claims trend on a per member per month basis. So across all fully insured markets in 2013, the average allowed claims trends has been declining over the past couple years, and in 2013, that number is 1.3%. Claims PMPM trends generally consist of two components. One is the utilization, and the second is cost and mix. So utilization is the number or represents the number of services provided. So it could be the number of admissions to a hospital or the number of prescriptions filled at a pharmacy. Cost trends are a combination of a couple things. One is the actual change in the unit price for a specific service, and it also includes the change in the mix of services or the change in the mix of providers being used by those patients. So as you can see, utilization trends have been negative the past couple years, so they're really one of the main reasons why overall total trends have stayed so low. And mixed trends have been estimated to be somewhere between the range of plus 1% and minus 1%, so fairly small. Therefore, with these negative utilization trends and these fairly small mixed trends, it's really the offsetting increase in unit cost or provider reimbursement that continues to be the main driver of trends. So as stated earlier, about 16% of premium is used to pay for expenses, which includes any state or federal taxes, fees, and assessments. Each market segment in 2013 did experience an increase in the actual expenses on a percent of premium basis from 2012 to 2013. So overall, the expense ratio increased from 15.5% in 2012 to 16.4% in 2013. And we can say that approximately half of this increase is attributed to fees and assessments, and the other half is attributed to increases in carrier administrative expenses. So the profit margin, or also referred to as contribution to surplus, is really the remaining piece of premium left after medical and pharmacy claims are paid and any expenses. In New Hampshire, the overall profit margin as a percent of premium has remained fairly stable at 5% for the past 2 years, although there are some differences by market segment. So in the individual market, the profit margin on a percent of premium basis has decreased a couple percentage points, and the large group market saw a very slight increase. So we're moving on to some information related to product design. While we've seen relatively low overall premium increases in New Hampshire, affordability of health insurance is still a major concern. Carriers in New Hampshire and in states across the country are continuing to explore product design options as a way to impact premiums. Two such examples of product design innovation in New Hampshire are site of service benefit designs, or also referred to as low-cost provider benefit designs, and tiered network products. So site of service benefit designs offer members decreased cost sharing if they use lower costing sites for specific services such as ambulatory surgeries and lab services. Tiered network products group hospitals and physicians based on cost and quality metrics and offer members decreased cost sharing if they were to use these higher quality, lower costing hospitals and physicians. So as shown in this chart, these options do continue to grow in popularity in New Hampshire, really led by the increase in membership in the site of service benefit option. So in December of 2010, approximately 14% of members were in these types of options, and that's grown significantly to 52% in 2013. So you can see that a lot of this growth is led by the small group market, where the site of service benefit option has become a standard offering for some carriers. And while not shown here, when you look at the self-insured market, we have also seen growth in these types of products, just not to the same extent. So given the growth in this particular this benefit option, this site of service benefit design, and in order to continue to understand the value proposition of this benefit design, data were collected for the top outpatient surgeries and lab services. We looked at both the average cost differences by site of service for members in this product and also utilization differences. So this slide presents information for one type of surgery as an example, gastrointestinal endoscopies. The table at the top of this slide summarizes the cost differences by site for outpatient hospital settings versus ambulatory surgical centers. So, and the allowed cost represents both the cost paid by the insurer and the cost paid by the member through any type of cost sharing. So the average allowed cost differences for this particular surgery is there's a difference of $1,350. So this type of surgery is less at the ambulatory surgical center, and the members by design are also paying less in cost sharing. So in this case, $793 on average. The chart below shows the difference in the percent of usage at ambulatory surgical centers for this type of service, both for members in the site of service benefit option, which is on the left, and those not in the site of service benefit option, which is on the right. So those in the site of service benefit option do use ambulatory surgical centers at a higher rate for these types of surgeries. So in 2013, that's the 45% versus the 38%. And over the 3-year studies, both members with and without the site of service benefit option are continuing to shift their usage toward these lower costing sites. But it's interesting to note that members not in the site of service benefit option are actually increasing their usage at a higher rate. So that's the 25% to the 38%. So the shift for these members not in the site of service benefit option may be due to several factors. For example, these folks, even though they're not specifically incented to use these lower costing sites, they very well could be in plans with high deductibles, so they will still benefit from the fact that they're using these lower costing sites, along with the fact that there could just be increased use and availability of these types of sites over time. The cost differentials and utilization results analyzed and looked at for the other types of surgeries and labs were directionally similar compared to this one example, and there's more details available in the full report online. So the one last product innovation we wanted to touch on was limited network products, and they can also be referred to as select or narrow network products. So the idea is that by not contracting with all providers or not including all providers in a specific region, the carrier is able to negotiate more favorable prices in return for offering greater volume to those providers. In 2014, there are 2 carriers in New Hampshire that are offering these types of products. And as of April 2014, 7% of the total fully insured market are in these types of products, really driven by the offering of this product in the individual market health exchange. So as reported by carriers, premiums for these plans can be anywhere from 10 to 30% lower compared to similar plan designs with a broad or full network. And as pointed out in the report, limited network products are prevalent in exchanges across the country, with one study reporting up to 70% of hospital networks on exchanges are considered limited. So the one last topic I wanted to touch on today is related to provider payment reform and the percent of members in risk-sharing type contracts. So both insurance carriers and providers in New Hampshire are engaged in evaluating opportunities to migrate away from fee-for-service models to pay-for-performance or risk-sharing models. The aim of these payment reform efforts is to better align financial incentives between the insurance carriers and the providers, with the goals of ultimately reducing unnecessary utilization, improving overall quality of care, and ultimately reducing costs to the system. Members in risk-sharing contracts is another metric we've been tracking over the past several years. The blue bar in this chart shows the percentage of members with providers in upside-only risk contracts, or contracts where the provider can only benefit from that particular arrangement. And red shows the percentage of members with providers in upside and downside risk contracts, or also known as full risk-sharing contracts. So while the percentage of members in risk-sharing contracts was fairly stable from 2010 to 2012, we have seen an increase in 2013, where now 13% of members are in upside-only risk contracts and 19% of members are in contracts with both upside and downside risk. And it's also worth noting, while not shown, that we saw similar growth of members in these types of contracts in the self-insured market. So some key takeaways. One is that overall premium trends have increased compared to last year, but they do remain relatively low when you look over a longer historical time frame. But at the same time, consumers are shifting toward products with higher cost sharing, like higher deductibles, especially in the individual and small group markets. And with negative utilization trends and relatively small mix trends, it's really increases in provider reimbursement or unit costs that are the main driver of medical claim trend increases in recent time periods. And when it comes to product innovation, site of service, benefit designs are one example that have shown significant increase in membership over the past several years. And lastly, while stable through the end of 2012, membership in risk-sharing type contract arrangements has increased in 2013. So again, the full report that has more information is available on the NHID's website that provides more context and additional information related to these findings. And again, any comments or questions we're going to take during the public comment period. But with that, I'll open it up to any questions or comments from the New Hampshire Insurance Department.
Yeah. With regard to the site of service benefit option, and recognizing that carriers use cost sharing to control utilization, so in other words, increase cost sharing on services that are maybe not hugely beneficial, decrease it on things like primary care. I wonder if you can speak to the fact that if you end up with people receiving or exposed to low cost sharing for things like surgery and lab services, if they're more likely to get those services, therefore increasing costs, I mean, does the carrier lose its ability to kind of steer volume or influence volume through cost sharing by trying to direct people to more cost-effective providers?
Because the cost sharing is decreasing?
Right.
I guess I would say, so we didn't have the data to look at that level of detail, but I think it is fair to assume that if you're going to lower cost sharing, there very well may be increases in utilization, because we do typically assume, or we've seen on the flip side, if you increase cost sharing, you're going to see utilization decrease. But I guess I would also say I think any increases in utilization in this case would probably be far minimal compared to the savings that's coming from the cost differentials. So, I mean, I think as these earlier slides shown, or there's more information in the report, there's the cost differentials we're seeing are upwards of 30, 40, 50% between these different sites. So I think the savings coming from the cost side would far outweigh any increases in utilization.
One of the striking findings. Thank you. Is this on?
Yes.
Mm-hmm. One of the striking findings in your presentation is the continued decrease in utilization by covered persons. And I was wondering whether there's any indication in the data that you looked at as to the cause of that, between the various factors that might contribute to that. Obviously, we have increased cost sharing going on, and that could be a driver. But we also have a sluggish economy in which we can imagine that people have less money to spend, and that also could be a driver. Is there any indication or any impression you got looking at the data about the cause of the decrease in utilization?
Yeah, I think it's probably driven by several different factors. And I guess I would say, I think many of you probably know New Hampshire is not unique. I think we're seeing this across the country and a lot of different states. So there's probably a bunch of different reasons. I think economists do look to the economy as one reason. So I think that probably is part of it. I agree again, yes, probably increased cost sharing is leading to that. I mean, we're not necessarily seeing, when you look at some of the detail, we're seeing decreases in inpatient and outpatient hospital utilization, but there are some increases in other categories like professional services and pharmacy. So I don't think we know for sure, but I think exactly all those different factors are contributing to it. And I guess I would say the other thing, I feel like there's a general consensus that this negative utilization is not here to stay. We're kind of in this downward cycle, but I think most economists, again, or that, if you read in the newspapers, the general consensus is this is not going to last forever, and that we need to do everything else we can to stay on top of trends when these utilization trends do start coming back up again. I think we were going to wait and hold public comments until our questions, if you don't mind. Thank you. But if there's any other questions or comments from the NHID.
Just another question. There's a fair amount of concern about some of the excessive profitability that some of the carriers have, and certainly you could make the argument that 5% is a pretty healthy margin. I guess my question is whether or not you think the MLR requirement to meet those minimums, and if you don't, the rebates, is an effective way of addressing that, or if we should actually be looking at some of the other measures, such as, expense ratios or something else in terms of the analysis you've done.
Yeah, I guess I would say I do think the ACA MLR requirement is one of the good ways to limit any excess profits, and I think we saw that happen in New Hampshire in 2013, where again the slide that shows in the individual market in particular, 3% of premium went back to policyholders, which is fairly significant. I can think of what other states are doing. So, for example, in Massachusetts, they explicitly limit the percent of profit that can be built into premium for individual and small groups. I think they explicitly limit that number to 1.9%. Again, in Massachusetts, and I think other states might be looking at this, they also limit the percentage change that can be built in on the expense side, excluding any fees or assessments, so that they limit it to CPI change over year. And then I guess the one last thing that comes to mind, not necessarily a measure, but I think it will be interesting to see what happens in 2015 in the individual market, where we do have New Hampshire has several new entrants to that market, so where in previous years that market has been dominated by one carrier, but going forward there'll be several new entrants to increase competition, so carriers are going to have to compete even more on price and quality of their products. So I think it'll be interesting to see what happens there, as increased competition should ultimately lead to more competition, or competing on price, and therefore ultimately lowering any excess profits.
Thank you, Jen. This is Roger Savini, by the way. Have you seen, or are you familiar with trends that you've just outlined to us, but elsewhere in other states and other jurisdictions, and how we compare to other jurisdictions?
Yeah, I guess I would say, I think what we're seeing in New Hampshire is very similar to what's happening in other parts of the country. I think most recently Massachusetts, where I have a lot of experience, they recently held cost trend hearings, and they have several reports available online, and the trends shown there are very similar. As far as utilization trends are negative, it's really unit cost or provider reimbursement that's driving increases right now. I think another good source is HCCI. I think they just released this week their report. So they have national employer group data from several large carriers, and they do a lot of drill down on trends and by service category. So when we've looked at that report in the past, I would say generally a lot of what's happening in New Hampshire is very similar.
Any other questions from members of the department? Like Jen said, there'll be ample opportunity for questions from anyone after the second panel does its work.
Thank you.